We've been telling you about the funding crisis in state pensions and endowments. Erik Upin knows the kinds of pressure they're under. He is a former chief investment officer at Stanford University, which has the third largest college endowment in America. Erik is now CIO at Makena Capital, a private money manager that employs the endowment investing model and runs money for sovereigns, for endowments, and Erik is here right now. Erik, let us talk about the most timely event of the week, or it is a timely topic in any case, Japan's decision to intervene to sell buy dollars, buy euros, we're not sure. What does this mean to you? You take a very long-term view and you blend in macroeconomics, market factors. What does it all add up to in your opinion?
Well, as hard and difficult and challenging as the environment is, and it's hard to ever know with one data point, and we really look at things over a long period of time, it is when you look at the amount of debt and the limited amount of growth globally, it has to make you wonder, is this the beginning of a set of competitive devaluations? Essentially lowering your currency to increase the desirability of your exports and keep employment up. And if many nations practice this, then becomes a competitive situation.
It's obviously the case that Tim Geithner is making to Congress today about the Chinese yuan, but who else might be lulled into this game?
Well, we think many Asian nations may that are more export-oriented, and it really looks like the UK may enter this game as well. It is a key policy tool. In fact, if you're looking at how to address excess indebtedness, lowering the currency, which has real material impact on the local population, can also be a very important policy tool. It's one of the most effective policy tools.
And it's exactly what Greece can't do.
Correct, yeah.
All right, let's talk about some of the approaches you're taking to investing using the endowment model. You know PIMCO's Rich Clarity. He talks about us living, what does the new normal mean? That's the phrase coined by his boss, Mohamed El-Erian. Rich interprets that to mean that we are no longer living in an age of what you might call average outcomes, the bell curve distribution. You have to pay more attention to the tails. Do you agree with that, and what does it mean if you're managing money?
Yes, I think PIMCO's added a great deal to the public debate, and I think that is probably the highest probability outcome based on several factors. One, we've been increasing debt across the entire spectrum of our economy in the developed world for the last 30 years. This is not a 10-year problem, a 5-year problem. Total debt to GDP has more than tripled across the developed world over the last 40 years. So a big part of economic growth and all the expansion we've enjoyed and seen is from increased debt. Secondly, during the period we enjoyed and saw as the salad days, were periods characterized by falling inflation, falling interest rates, falling taxation, falling regulation, and increased global trade and productivity. When we look at the next 10 to 20 years, if policymakers are successful, inflation, interest rates, regulation, taxation all go up. All those things affect valuations and potential ability to generate good returns on capital.
Now, how does that affect everyone's search for yield? Are the fat tails going to affect those, so to speak, riskier assets more, the ones that people are once again beginning to turn to, leveraged loans, high yield debt, in order to just find some way of making money when the 2-year Treasury is at 50 beeps?
Sure. I mean, again, as unpredictable and as humbling as the future and the present can make any investor, the concerns today is the flight to yield. Part of why pensions and endowments are in trouble is that the U.S. broad market index has underperformed cash in the market, cash in the mattress for the last 11 years. So this fight to yield, to try and find any degree of return, has put you in a position that makes you very vulnerable if rates or inflation start to spike up, and they can both spike up quickly. And the other danger is the flow of funds. If you really look at where dollars have been going, they've been coming out of equity funds and into the fixed income products. We saw this when all the dollars were flowing into the NASDAQ. We saw it when all the dollars were flowing into housing. Flow of funds means too many people on one side of the boat, and when there's the rush to either get into the middle or the other side is where the danger becomes.
With about 30 seconds to go, Erik, where does that leave us? Gold, other hard assets like farmland, maybe timber? Is that where you turn?
Well, I think first to be very diversified, because the range of outcomes and uncertainty is at its all-time high. That doesn't tell you a lot. I think the things that are actionable is, one, be extremely diversified. Two, you could argue equities could be more attractive than bonds at this point, generating dividends, and you actually own a productive asset versus an IOU. And perhaps most interesting to us is two things: emerging markets, it is the real deal, and being even more selective by geographies. And second, the natural resources complex, from commodities to farmland, across the entire commodity spectrum.
All right, Erik, it has been a pleasure having you here. Erik Upin of Makena Capital Management.